Imagine buying a $50 dinner tonight. It tastes great. You enjoy every bite. You tap your credit card and walk away. No cash leaves your wallet. No pain. No second thoughts. Now imagine that years later, that same $50 dinner has actually cost you more than $100. Not because the restaurant raised its prices, not because inflation doubled the cost, but because you carried that credit card balance and kept paying interest. This happens every single day across America. Millions of people make their monthly payment on time, yet they remain trapped in debt for years. Why? Because credit cards aren't just payment tools. They're designed around human psychology. Today, we're going to uncover how credit cards quietly keep millions of Americans in debt, how the system really works, and, most importantly, how you can avoid the same trap. In the United States, credit cards are a part of everyday life. People use them for groceries, gas, restaurants, travel, online shopping, medical bills, even small purchases like coffee. For many Americans, using a credit card feels completely normal. And to be fair, credit cards offer real benefits. They provide fraud protection, cashback rewards, travel points, purchase protection, and they help build a credit history. None of these things are bad. The problem begins when convenience changes behavior. Think about paying with cash. When you hand someone $50, you physically watch your money disappear. Your brain feels the loss. But with a credit card, you simply tap or swipe and walk away. The payment feels almost invisible. Psychologists have found that people often spend more when they use credit cards than when they use cash. Not because they're irresponsible, but because the purchase feels less painful. Credit card companies understand this better than anyone. The easier it feels to spend, the more often you'll use the card. And every swipe creates another opportunity for the company to earn money. That's where the debt cycle begins. Imagine you're shopping for a new smartphone. The price is $1,000. If you had to hand over 10 $100 bills, you'd probably stop and think, do I really need this today? Maybe you'd wait. Maybe you'd save for another month. But with a credit card, everything changes. You tell yourself, I'll pay it off later. That one sentence has created billions of dollars in debt because credit cards separate the excitement of buying from the pain of paying. You leave the store with the phone today, but the bill doesn't arrive until weeks later. By then, the excitement has faded. The phone already feels normal. But now you owe money. To encourage spending even more, credit card companies offer cash back, travel rewards, airline miles, welcome bonuses, limited time offers. These rewards make spending feel smart, and if you pay your balance in full every month, those rewards really can be valuable. But if you carry a balance, the interest often costs far more than the rewards you earned. Then comes the biggest trap of all, the minimum payment. A few weeks later, your credit card statement arrives. You spent $2,000. You expect the bill to be overwhelming. Instead, you see something comforting. Minimum payment. Due $50. It feels manageable, so you pay the minimum and move on. Problem solved. Or so it seems. Here's what most people don't realize. That $50 payment mostly covers interest. Only a small portion reduces what you actually owe. The balance barely changes. Next month, interest is charged again. Now you're paying interest. On top of previous interest. This is called compounding. The same financial force that helps investors build wealth can also keep borrowers trapped in debt. You continue making payments every month. You never miss a due date. But months later, you still owe almost the same amount. That's why millions of Americans stay in credit card debt for years. The minimum payment protects the credit card company, not your financial future. Most credit cards charge interest rates above 20%. Some charge even more. At first glance, 20% may not sound terrifying, but time changes everything. Imagine buying a $2,000 laptop. If you pay the full balance immediately, the laptop costs exactly $2,000. Simple. But if you carry that balance month after month, interest keeps growing. Now you're not just paying for the laptop, you're paying for borrowed money. Eventually, that same laptop could cost hundreds of dollars more, maybe even over $1,000 more if the debt lasts long enough. Nothing about the laptop changed. Only the financing did. This is the opposite of investing. When you invest money, compound interest works in your favor. Your money earns money. With credit card debt, compound interest works against you. Your debt earns more debt. The longer you wait, the more expensive every purchase becomes. That's exactly how credit card companies make billions every year. Most people don't fall into debt because of one giant shopping spree. Instead, debt grows quietly. A coffee here, a food delivery there, a streaming subscription, a weekend sale, a few online purchases. Each expense feels harmless. But together, they create a balance that's harder to pay off every month. Then life happens. The car needs repairs. A medical emergency appears. Hours at work are reduced. Suddenly, the credit card becomes your emergency fund. Instead of paying down the balance, you add even more purchases. Now interest grows faster. Soon, part of every paycheck goes toward paying for things you bought months ago. You're working today to pay for yesterday. That's when debt stops being convenient and starts controlling your financial life. The good news is, credit cards don't have to be your enemy. They're simply tools. Like any tool, they can either help you or hurt you. The key is how you use them. Only charge what you can afford to pay off. Pay your full statement balance every month whenever possible. Build an emergency fund so unexpected expenses don't automatically go onto a credit card. Ignore rewards if they're encouraging you to spend more than you normally would. Remember, cash back is never worth paying 20% interest. The real reward is staying debt-free. Use your credit card for convenience, not for borrowing money you can't repay. Before every purchase, pause for just a moment. Ask yourself one simple question. If this bill arrived tomorrow, could I pay it in full? If the answer is yes, you're probably using credit wisely. If the answer is no, it may be worth waiting. That single habit can save you thousands of dollars over your lifetime. Credit cards can be powerful financial tools, or they can quietly become expensive debt machines. The choice isn't in the card, it's in how you use it. If you found this video helpful, don't forget to like the video, subscribe to the channel, and share it with someone who needs to hear this. Thanks for watching, and I'll see you in the next video.